Hi everyone, I'm Jeff Sarti, CEO of Morton Wealth,
I'm Meghan Pinchuk, Chief Investment Officer, Morton Wealth.
and I'm really excited for this conversation. It's our 2023 year in review. 2023, very interesting year, really topsy-turvy in a lot of ways.
Yes.
Right? And so also 2024, we're going to talk about our outlook going forward for 2024 as well. A lot of uncertainty. We're going to talk about that, from geopolitical events to unknowns about the economy, inflation, to the election in the fall.
It's not going to be boring.
It's not going to be a boring year. So, and then we're going to also talk about our solutions to how to combat that uncertainty. We're going to talk a lot about diversification, really focus on resilient investments. So I'm excited about that conversation as well. But starting with 2023, a very strong year for stocks in particular. The S&P 500 was up about 26%. Those are larger US companies. Also, those smaller US companies, but still public companies, up in the 16 to 17% range. So not quite as strong, but still up a lot. International stocks also did very well, in the range of, call it 10 to 20% up, given the particular region or country. So with all that being said, can you talk a little bit more about stock performance?
Yeah, I think that 26%, it's a big eye-popping number, but there were nuances to it that are worth noting. One being just that, as has been typical in recent years, the top 7 stocks, now the new term being the Magnificent Seven.
Magnificent Seven. It was the old one was the FANGs,
right?
Right.
Magnificent Seven sounds a little fancier, so I like that. So these big 7 tech companies that really have driven a lot of the performance in recent years. So those companies had great years, just really, really outperformed. And so when you look under the hood a little bit, you see that the S&P 500 up to 26, but the S&P 500 equal weight only up 14%. And
can you talk about the difference between those two?
And so the main index that everyone tracks is what's called a capitalization weighted index. Basically, the biggest companies have the biggest weights. And so those big companies that did so well really drove a lot of that performance. On the equal weight, when you just take the 500 companies and it doesn't matter how big they are, everything's the same. Still a good number, up 14%, but just not quite as that big of outperformance as the broad index. So now going forward, I think the question is to look at why stocks were up so much. And I think we talked about it a lot, but to some degree, it seemed like it was expectations.
A lot of it was around expectations. If you think going into 2023, rewind back to what happened in 2022, 2022 was a very tough year for stocks and the economy, inflation, et cetera. So going into 2023, I think most market experts and investors were concerned and somewhat pessimistic in thinking about what would unfold in 2023. Now, when the data ultimately came in, it surprised to the upside. The data was rosier than what was otherwise expected. Inflation, as an example, started the year in 2023 in the mid 6% range, came down meaningfully, ended the year in the low to mid 3% range. Still didn't quite hit the Federal Reserve's 2% target, but that being said, came down a lot. Employment as well. Employment stayed very strong. Unemployment is still in the 3.5% to 4% range. So the labor market is strong, and we didn't tip into a recession. So when you take all those things into account, the economy surprised the upside, so stocks did well. Now, with all that being said, that was just one year. In many ways, the strong performance in 2023 was just a round trip from 2022.
Right.
If you take that 2-year performance on stocks were basically flat. So when you take a 2-year outlook, looking backwards, the performance wasn't that great.
Yeah. And now when you get to the next topic, which is everyone's favorite, predictions, right? So what's going to happen in 2024? I think it's not surprising, coming off of how strong last year was, that predictions are very rosy. So things are going to be great, sentiment's high. It escapes me why there's such confidence in these predictions, mostly because now we have this interesting period where the predictions got completely, turned on their heads multiple times. So going back to 2021, when inflation started ticking up and you had the whole Fed dialogue about how everything was transitory. So it's transitory, don't worry, no action necessary.
And they were so confident.
So confident, at least all the language coming out was. And so then, they get into 22, they waited until inflation hit 8% before the first rate hike. But then, shockingly, they're behind the curve, so they had to do the fastest rate hike cycle in history. And guess what? Markets didn't like that. So 2022, as you alluded to, stocks were down, high teens. The bond market, this was actually the bigger news, was the bond index, the broad bond index was down 13%. Worst year in its history. And, for a safe asset class, that was pretty bad. So then, coming off that period, the predictions for 2023 were very negative. There was a lot of concern. Are stocks going to be negative? How are things going to go? And so now, again, you have this amazing outperformance despite the predictions. So 2024, we go, everyone's excited again. Everything's great. Don't worry. And when we look at it, we just say, why spend so much energy trying to predict? It's really, and it's the way you wrote about it in your recent perspective letter, but that's how people combat uncertainty. There's this feeling of nervousness that you can't control what's happening with markets. So how do people try to control it? They try to create predictions. And in our case, we just say, like, it's just wasted energy. Like, let's not try to predict. Let's just say we're gonna mix in other things, other resilient investments, and not have to get it perfectly and kind of control it that way.
So I'm excited to spend more time talking about uncertainty and how we do embrace uncertainty and our solutions to combat that uncertainty. But before we move on from stocks, I did want to just have some quick commentary on stock valuations. Stocks are trading at expensive valuations. The PE, or price to earnings ratio, on the S&P 500 is roughly 20 right now, higher than historical norms, which is typically, let's say, in the low to mid-teens. And the most important driver of future stock returns are the starting point of valuations. And that sort of makes sense.
It does, right? If stocks are cheap, you would expect better returns going forward. If they're expensive, the opposite.
Right. 1970s, an example, stocks were cheap. The ensuing couple decades, stocks did well. 1999, dot-com bubble, stocks were trading at expensive valuations. Then the decade of the 2000s, stocks were flat. So again, valuations really matter. Another way to think about valuations and really stock performance is what should drive stock performance over time is earnings growth. And so if simple example, let's say you have a company that makes $1 million of earnings, and over time, let's say it doubles its earnings to $2 million. That stock price should roughly double.
Okay, makes sense.
If that stock price triples or quadruples instead of doubling, it's really veering away from its fundamentals. In essence, all that's happening is its PE ratio is rising.
Right. It did well, but it didn't do that well.
Right. And so over time, theoretically, that PE ratio should fall. And what at its core drives stock earnings? It's the growth rate of the underlying economy. So the growth rate of the underlying economy should grow stock earnings, which should ultimately grow the stock price. So I'm going to show these correlations in a quick chart. I'm going to pull up a chart here. And what this chart shows is going back to the 1950s. The red line is the growth rate of the US economy, which is a proxy for the growth rate of stock earnings. And the more volatile line is the appreciation of stocks over that time frame. And you can see, of course, stocks are going to be more volatile than the growth rate of the underlying economy, but generally speaking, these two should move in line with one another. But occasionally they get out of whack. And what you see as an example in the 1950s or 60s, coming out of World War II, tremendous optimism that our country was facing, stock prices really shot up. And they should have. Stocks did well over that time frame, but they grew faster than the rate of the economy or the underlying earnings, and they dislodged from fundamentals. So what happened? They had to come back to earth, and they had to be pulled back. You could see pulled back to the red line almost acting like an anchor or magnet, and those high valuations became low valuations. So over the course of this 1960s or 70s, ultimately going down to the lows, in terms of valuations in the early 1980s, stocks were ultimately cheap. Now they were trading at PE ratios that were too low. Fast forward through the 90s and accelerating through the late 1990s dot-com bubble, stocks yet again outperformed earnings or economic expansion and growth rate. PE multiples expanded and they were trading too expensively. So you could see this zigzag motion. Yep. And you can see ultimately here on the right side of the chart where we're at today. Yeah. Stocks in many ways have dislodged from fundamentals.
Right. And there are, in periods like you mentioned after the World War II and stuff, there's reasons sometimes why this happens. And I think we ask ourselves today, what's the reason for it? And one of the key things that we believe is a big cause is related to debt. So just there's so much money printing that's gone on, so much money out there that to a large degree has really pushed stock valuations higher than their fundamentals.
One just quick note on the debt. We've talked about this a lot. The explosion in debt in recent years has been extreme. Rewind back to only 15 years ago, 2007-8, our national debt was in the $7 to $8 trillion range, and now we're north of 30 trillion.
Kind of crazy.
So it's just kind of an extreme, and that really is pushing stock prices higher. One other just quick example on price to earnings ratio. You talked about the Magnificent Seven, wonderful companies that are growing, but they are trading at lofty multiples. I'll give one example. Apple, an incredible company, don't get me wrong, but it's trading now at a 30 price to earnings ratio. Typically speaking, that trades sort of, call it, in the mid-teens. So then you would think, oh, why is it trading at such a high multiple compared to its historical average of, let's say, the mid-teens price to earnings ratio? You would think maybe it's growing at a faster rate, but that's really not the case. Over the last, call it, 4 to 5 quarters, Apple's sales or revenue has been flat to negative. It's a pretty remarkable stat. That's the worst performance in the last 22 years for Apple, yet it's trading at a 30 PE ratio. That just feels like a very vulnerable situation.
Yeah. So the stock's performing well, but the fundamentals are weakening, essentially.
Completely agree. And I think that that's an example of, and we've talked a lot about this, not confusing a good company with a good stock.
Right.
And maybe an analogy that we can make is, think about if you're buying a home. Let's say you're home shopping, you go to an open house, and you see a beautiful home, great curb appeal, you go in, it's been remodeled, and you think, wow, this home price should be worth, I was going to say 1 million, but 1 million doesn't buy you much these days.
Not in Southern California.
Not in Southern California. Let's say $2 million. That's what you're like, beautiful home, should be priced at $2 million. But then you look at the offer price, and the offer is for $3 or $4 million. Disconnect there. Wonderful home, beautiful home,
yeah,
but not trading at a good price. You would potentially be more of a seller at that price as opposed to a buyer. So I just give that example to highlight in many ways how we think about many of these Magnificent Seven stocks. Good companies, but potentially not great stocks.
Interestingly, the home example, obviously buying a home, very emotional. Mm-hmm. I think there's a lot of emotion around these stocks too. There's a lot of people feeling very connected to the stocks. They made a lot of money on it. They feel like they know the company because they own the products. So there is a certain sense of inertia, I think, also when it comes to people just logically saying, hey, look, this has done great, let's trim our profits. And so just as the index, it's grown, these companies have, I think, become a bigger and bigger percentage of people's portfolios. So vulnerable or exposed in the event the valuations do come back down to more normal levels. So speaking of valuations, though, it is, even though we're talking the broad index now, there are pockets of the stock market that we think are attractive and that have more reasonable valuations. And so just to name one, we do have an allocation, a small one, to natural resource stocks. Mm-hmm. And so the reason for this comes back to the composition of the index, the idea that, again, the tech stocks are such a big piece, they're really driving things. We look now and say, okay, we have this overexposure to some degree. Natural resource stocks, between oil and gas companies, metals, materials, they are actually only about 6% of the index now. So really a very modest percent. And that's low even relative to history. So back in the 80s, I think it was close to 30%. Yep. There have been periods over the last few decades where it was 15 to 20%. Mm-hmm. So again, now for it to be this small, something this essential to our daily lives.
These are things we need.
These are things we use every single day. So things that economies need to grow, right?
Sure.
To continue growth, you have to have these things. So again, a modest allocation to bring us more in line with what we think is sort of reasonable exposure. And so these did poorly last year, mm-hmm. or I guess poorly on a relative basis. Depending on which index you look at, they were anywhere from down small to up small. Mm-hmm. But against a 26% return for the S&P, obviously underperforming. And it's just important to remember that the long-term thesis for these hasn't changed, and it's okay to have things that behave differently in the portfolio. So as long as the reasons haven't changed, we still like these, think that the returns will be good over the long term. The idea that something doesn't move in lockstep with the S&P 500, actually a benefit to a large degree. Because I know it feels good when everything's up at the same time, but it doesn't feel quite as good when everything's down at the same time.
Well, along those points, if everything is moving up together, that's wonderful, but that should also be concerning.
Yes.
Right?
Yeah, that's the definition of diversification, right? Things do not necessarily move in lockstep. So if everything's going up, you're going to have a problem on the way down.
Related to natural resource stocks, we've had a core position in gold for quite some time. And gold has really held its own and done well, especially in recent years. In 2022, by way of reminder, gold was roughly flat. And that really actually was really strong returns because everything was down in 2022. So it really held its value in 22. Last year in 2023, gold was up in the 12 to 13% range. So really strong performance, and really now is just trading at, call it right around $2,000 an ounce, right near all-time highs. So gold has really been a nice insurance policy hedge for us against currency depreciation, something we've talked about a lot. Going back to your discussion around debt, one of our concerns that we've hit on a lot in recent years is with all the money printing, debt binge across the world, the path of least resistance from not only the dollar, but all global currencies is a devaluation, a debasement over time. So gold really, we believe, represents a good hedge or insurance policy against that. And it also really represents what we believe a hedge against uncertainty, which we're facing a lot of.
We are facing a lot of it. So if you think about the backdrop of what we're dealing with and why I think a hedge against uncertainty makes so much sense now more than ever even, between geopolitical risks, right? Everyone knows what's happening in the Middle East. The Russia-Ukraine war continues, the tensions between China and Taiwan. There's a lot of uncertainty out there. What kind of crisis or event could really derail the global economy? Inflation, even though it's come down meaningfully, it's still also on a percentage basis, very much above what the Fed's target is. And so just small changes in expectations, the idea that maybe things are a little stronger, or if it's a little sticky inflation and stays a little higher, does the Fed just not lower interest rates as quickly as the market's expecting? And does that have a big impact? And then my favorite, which is the election this year, which is set to be a whole bunch of fun. So between all of this uncertainty that's out there, again, we come back to this concept of not trying to necessarily predict. Sentiment's very high. Everyone's thinking it's going to be a great year coming off such a good 2023. But instead of us saying, great, let's pile all in, you have to some degree look at the fundamentals, say, let's not try to predict. We're going to keep our stocks. So if things keep running, we have stock exposure. But the flip side is let's build in more things that are resilient, different kinds of investments that are just going to behave differently. And I know we're going to come back to that, which is an exciting thing, an example. But first, I think we'd be remiss if we didn't at least a little bit hit on bonds. So.
Yeah, bonds are obviously an asset class that we're invested in. And bonds have had an interesting history in recent years. Again, rewinding back to the 2008 through, call it 2021 timeframe when interest rates were roughly zero, we largely avoided traditional bonds because you really weren't being paid anything to take on that type of risk, right? Then in 2022, the bond market, as I think you quickly mentioned earlier in this discussion, was down 13%. Again, we largely avoided those risks. But then on the heels of that, with rising interest rates, we started getting excited about opportunities in bonds for the first time in many years, right? So this is something we've talked about.
First time in my career.
Right? This is something we've talked about in recent discussions. And so we really reallocated our bond funds, made a lot of changes in the last 12 to 18 months, and we really had very strong performance in 2023. The bond index was up roughly 5.5% or so, and the large majority of our bond funds did even better than that. We're up in, call it, the 6 to 10% range. So really strong returns, in many ways equity-like returns, but with much reduced risk in bond land. And we continue to be excited for a lot of the opportunities that we're seeing in other bond areas.
It suddenly became a really interesting asset class and added it to the portfolio, right? Instead of somewhere that you were sort of almost parking money to a large degree. So it is exciting. All right, so resilient investments, we keep promising, my favorite topic. So wanted to give an example because I feel like we do use this word resilient a lot where we're saying resilient investment. And so what do we mean by that? I think examples help. And one manager that we invest with is very big into equipment leases right now. And so to set the framework for this, I think it's good to go to a quick example of a car lease because that's something that most people are familiar with. So if you lease a car, you might go and say, let's buy, for round numbers, a $100,000 car, and it's a 3-year lease. The car company is going to assume some residual value to that or some value that the car is worth after the 3-year lease. So let's say
that's the depreciation of the car over time.
Exactly. They're going to say it's not worth as much in 3 years. Let's say in this example, it's worth $60,000. So now to figure out how much your lease payment is, they're basically assuming you're paying the difference, right? That $40,000, the difference between the 100 and the 60. You're going to pay for that plus the interest rate, all that good stuff. But now at the end of the 3 years, the car company gets that car back, and are they, what's it worth? And so if they were right in their predictions, maybe it's worth $60,000, maybe it's worth a little more. If it's worth less, do they potentially have a loss?
And that feels like a vulnerable position if you're the car company, because let's assume there's a recession, maybe people aren't buying cars as much. Now they're taking that car back, and hopefully they can sell it or release it at that $60,000 level, but maybe it's only worth 40 or 50,000, and they might have to take a loss.
Right. Maybe that car's out of vogue. There's a lot of risks to, is that asset not worth what they thought it was going to be at the end of it? So to contrast that, very different the way than we do equipment leases. Mostly with equipment leases we're talking about, it's not individuals, it's companies. A lot of companies might say they want to lease equipment instead of buy it. It affects their accounting differently. So there's some good reasons why they might prefer this. But in this case, the group that we're investing with, they're creating these leases and they're 3-year leases, but instead of assuming some estimated random residual value at the end of it, they're assuming 0 residual value. So this company over that 3 years is paying for the whole amount of equipment basically.
You mentioned, like, you gave an example the other day about like an agricultural company. Can you like kind of give that type of example?
Yeah, let's say a company that wants to, they need a tractor or a fleet of tractors to basically operate their business. And that is a key too, is you want an asset that's essential to the company, not something ancillary, but something that they need in their day-to-day operations, or else it's, they're essentially not in business anymore. So this company might lease this whole fleet of tractors, and again, over that first 3 years, they're paying for the entire fleet. So very quickly, from our perspective, risk is coming off the table because we're getting such quick payments, such quick amortization payments of our principal back, that if you fast forward a couple years into the lease, this fleet of tractors is worth meaningfully more what you have outstanding in terms of risk.
So just to kind of clarify on the numbers, as an example, you mentioned a 3-year lease. So let's say after 18 months or 2 years, partway through the lease, something unforeseen happens. Maybe the company doesn't want to defaults on the loan and doesn't want to keep paying. We've been paid back tremendously in terms of principal reduction because of that accelerated amortization schedule. So now if we take back those tractors, again, our principal payments have mainly been paid back, and then we can release or sell those tractors off and recoup our profits.
Right. And so the idea being, again, you've got the odds of the company not paying are lower, again, if the company's in business at all. But if something does happen to the company, you've got a really good backup plan, which is you've got assets that are worth meaningfully more in most cases than the amount that you lent. They can be released, they can be sold. So it's something, again, the resiliency of the economy, things can go haywire, interest rates, whatever happens, like this structure that's around these equipment leases is really resilient to the downside.
I love that example. It's a real tangible example. And again, speaking back to uncertainty, we talk about the future, what 2024 holds. We talk about geopolitical risks. We mentioned the election. If any of those things go in a unfavorable direction, think about that tractor example. I mean, again, feels very resilient. A lot can go wrong in those other areas, and we'll still be okay with a lease such as that.
Right. And so I think, too, one thing that we like about it a lot is not just the downside. So I love the downside. I love the resiliency of it. The returns also to the upside are contractual. So we're not at the mercy of public opinion.
Yeah.
One thing that drives me crazy about stocks is just that I need someone else, we've talked about this before, I need someone else to agree with me, that it's worth more basically to make money on it.
Yeah.
And so with these other kinds of investment, you don't need that. I have a contract. It's a short-term contract. I know what I'm going to get paid. It's locked in. And so it's not just resiliency to the downside. I think it's actually really attractive to the upside too.
So related to that, we talk about downside. That's obviously our primary area of focus, risk management, protection of principal. But on the upside, we are being paid, we believe, very well for the risks we're taking with these types of assets, especially with rising interest rates in recent years. That equipment lease example, what are we making roughly?
Usually like low double digits net of fees.
Low double digits, so really attractive returns. When you think across our private lending spectrum, in the real estate lending space, we're making high single digits. With these asset-backed loans, making low double digits. So to make, again, what we believe to be equity-like returns, even potentially better than equity-like returns, at much reduced risk. I mean, that risk-reward trade-off, it feels very obvious to us.
Yes, very attractive.
So again, somewhat related to lending in general, we had an interesting discussion with a client the other day where he asked the thoughtful question of how much lending is appropriate in his portfolio.
You love this stuff, but how much can we really do?
Right, because we do love it, and we've been continuing to add to it across our client portfolios. And I just wanted to be thoughtful and answer that question maybe in a slightly different way, because many, when they think of lending almost like a sector or an asset class, and then with that mindset that we should only have a certain amount in lending. But I think we think about it a little differently. Really, there are two ways to invest. You can either lend or loan on something, or own and buy something. So let's almost think about like bonds and stocks. So on the owning side of things, with stocks or let's say real estate, typically more volatile, maybe more upside, but typically with leverage. When you buy a stock, it's a levered company, there's debt involved, et cetera. Versus the lending side, where again, you talked about you have a contractual relationship. and most importantly, you're in a secure position, often in a first position.
Right.
So a much more secure position. So again, when we think about those trade-offs, how much can we have in lending? The answer is, depending on a client's risk profile, it could be a lot of their portfolio and potentially even the meaningful majority of their portfolio. So I wanted to just mention that quickly. That being said, there are illiquidity concerns or constraints. Do you want to talk a little bit about that?
Yeah, there are. And when you say lending, again, I think that would include, or we would think of that as including bonds
Yep.
as an example that are more liquid. But on the private lending side, even though these are short-term loans, there's some element of illiquidity. Usually the company or the fund's asking you to lock up money for a year, maybe 2 years. And then again, the nature of the short-term loans being that usually you can get a good amount of your money back pretty quickly. The flip side is everyone's different with liquidity. Their situation's different. And this is where I think we're talking a lot about investments today, but obviously the financial planning piece of what we do is so important.
Yeah.
And tying it in for each client as to how much illiquidity, can or should they take. I think that when you look to invest, people really cherish liquidity. To some degree, that's why you're paid extra for taking on illiquidity. But no one needs 100% of their portfolio liquid every day. So the idea that you have to push a button and get everything, if that's really what you need because you're going to buy a house or you're going to have something you spend it on, you really shouldn't be invested in anything at all. So.
Love it. So in summary, we talked about a lot today, but the primary theme, again, hitting on this theme of uncertainty, 2024, a lot of unknowns that are coming down the pipeline, right? From what's going to happen to the economy, geopolitical risk, and the election, just to name a few.
Yeah.
And we obviously have concerns, but the flip side is, how are we positioned to combat those concerns in these resilient investments? We're very excited about the opportunities we're seeing. We feel like we could sort of have our cake and eat it too, meaning be conservative in these lending profiles, but still generate equity-like returns, really attractive returns, again, while still being resilient along the way.
Yeah, definitely. It's going to be fun.
So with that, really enjoyed it, and thanks everyone for watching.